Hello, everyone. As global central bank digital currency (CBDC) initiatives continue to advance, the categorization of their types has gradually become a key dimension for understanding the CBDC system. Today, we will be studying Section 4.3, Types of Digital Currencies, from the course Development of Digital Currencies. Imagine this. In the future, your wallet won't hold paper bills anymore. Instead, it will contain digital cash issued by the central bank. What you might not realize is that this digital currency actually comes in different forms. Some work like a wholesale counter, designed exclusively for banks, while others are more like loose change that anyone can use in everyday life. In this session, we'll explore the three main types of central bank digital currencies and uncover the fundamental logic shaping the future of finance. Our discussion will approach CBDCs from three perspectives: how the technology works, how accounts are structured, and how these currencies can operate across borders. By the end of this session, you will be able to 1. Clearly distinguish the three main types of CBDC and understand the key differences between wholesale and the retail models. 2. Grasp the technical principles behind account-based and token-based systems. 3. Identify the application scenarios for closed-loop and interconnected models. So, how exactly are central bank digital currencies classified? Let's go through them one by one. The most straightforward way to classify CBDC is by who they are designed to serve, based on technical architecture and user scope. CBDCs can be divided into two broad categories: wholesale CBDC and retail CBDC. 1. Wholesale CBDC. 1. Target users. A wholesale CBDC is designed exclusively for financial institutions such as commercial banks and clearing houses. It is not available to the general public. The primary goal of a wholesale CBDC is to enhance the efficiency of core financial infrastructure. For example, by streamlining large value payment settlements and reducing settlement risk. 2. Typical application scenarios. Interbank settlement serves as an alternative to traditional real-time gross settlement (RTGS) systems, enabling second-level settlement for cross-border or cross-market transactions. Example: Singapore's project Yubin demonstrated how wholesale CBDC can be used to achieve simultaneous settlement of multi-currency foreign exchange trades. Securities clearing and settlement supports delivery versus payment in bond and equity markets, effectively eliminating counterparty risk. 3. Technical features built on distributed ledger technology (DLT), but with the central bank retaining full control over access and node permissions to ensure system security and settlement finality. 2. Retail CBDC. 1. Definition and public value. A retail CBDC is issued directly to the public as a digital form of cash. Its primary purpose is to foster financial inclusion by providing a secure and accessible payment option for individuals without traditional bank accounts, while at the same time safeguarding the central bank's role and monetary sovereignty in an increasingly digital economy. 2. Global practice cases. China ECNY operates under a two-tier model where the central bank issues the currency and commercial banks distribute it through digital wallets. It supports features such as dual offline payments and smart contracts, ensuring secure and versatile transactions. Bahamas, $100, the world's first officially launched retail CBDC, designed to address the challenges of providing financial services across a geographically dispersed island nation. 3. Design principles. Retail CBDC is designed with a strong emphasis on user privacy protection through controllable anonymity, system resilience against cyber attacks, and interoperability with existing payment tools. 3. Exploring hybrid architecture. Some countries attempt to connect the wholesale and retail systems. For example, the proposed digital euro framework under the euro system introduces a tiered remuneration model. Basic individual holdings would be interest-free, while large balances would be subject to negative interest rates. This approach aims to facilitate everyday payments while mitigating the risk of financial disintermediation. Now that we've explored who each type of CBDC serves, let's turn to what it is, in other words, its technical form. From this perspective, CBDCs can be classified into account-based and token-based models. 1. Account-based CBDC. 1. Operating mechanism. Users are required to open a digital identity account with the central bank or an authorized institution. Transactions are essentially recorded as increases or decreases in account balances, representing the transfer of value. In essence, this model functions as the electronic registration of the central bank's liabilities. 2. Advantages and challenges. Advantages. It is naturally compatible with anti-money laundering (AML) frameworks and can support targeted monetary policies, such as the precise distribution of digital consumption vouchers. Challenges. It requires a robust identity verification system, which may raise concerns over user privacy. In addition, it demands extremely high system resilience, as a single point of failure could disrupt the entire network. 2. Token-based CBDC. 1. Operating mechanism. A token-based CBDC uses encrypted digital tokens to represent monetary value. Ownership is proven through a private key, and the transactions are settled by verifying the authenticity of the token and the digital signature of the holder, eliminating the need for intermediary accounts. 2. Typical example, China's ECNY adopts a controllable anonymity token model. Low-value transactions only require verification of the token's validity without linking to the user's identity. High-value transactions activate a traceability mechanism managed by the central bank, striking a balance between privacy protection and regulatory oversight. 3. Technical foundation built on the UTXO, unspent transaction output model, similar to the framework used by Bitcoin, but with centralized issuance and control by the central bank. 3. Evolution of hybrid models. Current CBDC initiatives are increasingly exploring hybrid approaches that combine account-based and token-based features. 1. China ECNY, primarily token-based, but digital wallets are tiered and linked to verified identity information, such as mobile numbers and national ID cards. 2. Sweden e-krona implements a dual-track system, with both accounts and tokens running in parallel. accommodating different payment scenarios. Finally, let's examine CBDC from a broader perspective. Cross-border interoperability. This determines whether a CBDC remains self-contained or is integrated into the global financial system. Based on cross-border interoperability, CBDC can be classified into closed-loop and interconnected models. 1. Closed-loop domestic CBDC. Most early pilot projects, such as China's ECNY, focus on domestic payment scenarios. Their core objectives include 1. Replacing cash circulation to reduce social management costs. 2. Safeguarding monetary sovereignty by mitigating the influence of private stablecoins. 3. Providing a safe haven asset during financial crises, such as bank runs. 2. Interconnected multi-CBDC arrangements to address the common challenges of high cost, slow speed, and low transparency in cross-border payments. New multilateral platforms have gradually emerged. 1. mBridge project, led by the Bank for International Settlements, connects the central banks of Hong Kong, Thailand, the UAE, and China to enable direct settlement and conversion of multiple CBDC. A notable achievement is that cross-border transfers have been reduced from 3 days to 10 seconds, with costs cut by more than 50%. 2. Dangba project, Singapore, Australia, etc., establishes a unified multi-currency clearing ledger enabling real-time payments across supply chains for multinational corporations. 3. Bilateral linkages. A representative example is the connection between Canada's Jasper project and Singapore's Ubin project. Using hash time-locked contract (HTLC) technology, these projects enable atomic swaps between Canadian and Singaporean CBDCs, effectively mitigating exchange rate volatility risks. Alright, everyone. In this lesson, we have seen that CBDC classifications are far more than technical labels. They are a concrete reflection of national financial strategy. 1. Wholesale versus retail delineates the service boundaries, balancing efficiency and financial inclusion. 2. Account-based versus token-based defines the trade-off between privacy and regulatory oversight. 3. Closed-loop versus interconnected reflects the dialectical relationship between monetary sovereignty and international coordination. The future CBDC landscape is expected to feature a diversity of coexisting architectures with layered interoperability, profoundly reshaping the global monetary governance framework. It is hoped that today's lesson has opened a window into the world of CBDC, helping you not only understand their classifications, but also grasp the underlying financial logic. That concludes today's lesson. Thank you for your attention, and we'll see you in the next session.